Hi, welcome back. Today, let's explore what happens when an entity transfers a financial asset and how it decides whether to keep the asset on its books or derecognize it entirely. When you transfer a financial asset, the first step is to assess how much of the risks and rewards of ownership you've actually transferred. Here's where it gets interesting. If you've handed over substantially all the risks and rewards, the asset no longer belongs to you in an economic sense. In this case, you derecognize it. But any rights or obligations created by the transfer, like guarantees, would need to be accounted for separately. What if you keep most of the risks and rewards? In that scenario, you continue recognizing the asset. It's still yours from an accounting perspective, even if it's technically been transferred. Now, there's a middle ground too. Sometimes you neither completely transfer nor completely retain all the risks and rewards. In this case, the next question is, do you still have control over the asset? If you've given up control, the asset is derecognized, but any rights or obligations related to the transfer are accounted for separately. If you've kept control, you continue to recognize the asset, but only to the extent of your involvement. For example, if you're exposed to changes in the asset's value, that exposure defines the level of your involvement. Ultimately, the deciding factor is whether you've retained control. If control is lost, the asset is derecognized. If control remains, the asset stays on your books, but only partially if your involvement is limited. This balance ensures financial reporting reflects the reality of who bears the risk and enjoys the reward. Thanks for tuning in, and I'll see you next time.